Imagine becoming one of the wealthiest individuals on the planet. How did Warren Buffett, with a net worth of over $141 billion, achieve such monumental success?
Let me give you a figure that'll blow your mind, I think. I bought my first stock when I was 11 years old. It was the first quarter of 1942. I spent $114.75. Three shares, $114.75. If I put that 114 into the S&P 500 at that time and reinvested the dividends, think of a figure as to what it would be worth today. Oh man, $400,000 today in one person's lifetime. Now, the market's gone down many times during that time. People have panicked during that time. Headlines have been terrible. But if you buy it for 10, 20, just keep buying the S&P 500 index and forget about all the other nonsense that's being sold to you.
The secret lies not just in making the right moves, but in avoiding the wrong ones. As Buffett famously said, you only have to do a very few things right in your life, so long as you don't do too many things wrong. Today, on No Money, we will dive into the top 3 investment mistakes Warren Buffett advises you to avoid. These insights could be the key to securing your financial future. Let's dive in. After nearly 7 decades of experience, investing legend Warren Buffett has accumulated more than $141 billion in personal wealth. The Oracle of Omaha believes much of his success is based on his ability to avoid losing money. His advice can be boiled down to 3 critical mistakes investors should never make. Let's explore these in detail. Number 1. Speculating instead of investing.
All investment is laying out some money now to get more money back in the future. Now, there's 2 ways of looking at getting the money back. One is from what the asset itself will produce. That's investment. One is from what somebody else will pay you for it later on, irrespective of what the asset produces, and I call that speculation. So if you are looking to the asset itself, you don't care about the quote because the asset is going to produce the money for you. And that's what society as a whole is going to get from investing in that asset. Then there's the other way of looking at it is what somebody will pay you tomorrow for it, even if it's valueless. And that's speculation. And of course, society gets nothing out of that eventually, but one group profits at the expense of another. We don't care whether something's quoted because we don't buy it with the idea of selling it to somebody. We look at what the business itself will produce. We bought See's Candy in 1972. The success of that has been because of the cash it's produced subsequently. It's not based on the fact I call up somebody at a brokerage house every day and say, what's my See's Candy stock worth? And that is our approach to anything.
Many investors fail to recognize the difference between a speculative asset and an investment-worthy asset. According to Buffett, the key difference lies in how the asset generates a return. This distinction is crucial for long-term financial success. All investment is laying out some money now to get more money back in the future, Buffett once explained. Now, there are 2 ways of looking at getting the money back. One is from what the asset itself will produce. That's investment. The other is from what somebody else will pay you for it later on, irrespective of what the asset produces. And I call that speculation. Based on this philosophy, assets that produce income organically are considered investment-worthy. Examples include farmland, profitable companies, dividend stocks, and real estate investment trusts, REITs. For instance, owning shares in a company that consistently pays dividends means you receive a portion of the company's profits regularly. This income is generated regardless of the stock's market price, making it a reliable investment. On the other hand, speculative assets like Bitcoin, fine art, or an unprofitable tech startup are highly exposed to unpredictable market sentiments. These assets rely on the hope that someone else will pay more for them in the future, a practice rooted in speculation rather than intrinsic value. For example, Bitcoin's value can fluctuate dramatically based on market hype or regulatory news, making it a risky investment. Investors looking for exposure to robust earnings should consider assets that generate consistent returns. For instance, the iShares Core Dividend Growth ETF, DGRO, focuses on companies that consistently grow their dividends, ensuring a steady stream of income. This ETF provides a diversified portfolio of high-quality dividend-growing companies, making it a sound investment choice. Number 2. Trying to time the market. Market timing can be incredibly tempting for investors. The idea of buying at the lowest point and selling at the highest point seems like a sure way to maximize profits. However, even the most experienced investors struggle with predicting market movements accurately. Warren Buffett cautions against trying to time the market. He believes that market cycles are unpredictable, and attempting to time them can lead to missed opportunities and increased risk. Instead, Buffett advocates for a strategy known as dollar-cost averaging.
So I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time, because the very nature of index funds is that you are saying, I think America's business is going to do reasonably well over a long period of time, but I don't know enough to pick the winners, and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally I think I know enough to pick a winner, but not very often. And I certainly can't pick winners by going down through the whole list and saying this is a winner and this isn't, and so on. So the important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time.
This approach involves investing a fixed dollar amount into the market at regular intervals, regardless of the market's current state. Data from RBC Global Asset Management illustrates the effectiveness of this strategy. Their analysis showed that an investor who perfectly timed the market only slightly outperformed an investor who consistently invested a fixed amount into the S&P 500 every month from 2004 to 2023. This slight difference highlights the difficulty and potential pitfalls of trying to time the market. By adopting a dollar-cost averaging strategy, investors spread their risk over time and avoid making large investments at potentially inopportune moments. This method reduces the impact of market volatility and leverages the power of compound interest, leading to steady growth over the long term. Staying invested is key. Market fluctuations are inevitable, but the market has historically trended upwards over extended periods. By remaining invested, you can benefit from this overall growth and avoid the stress and potential losses associated with market timing. Buffett's advice is clear. Rather than trying to predict the unpredictable, focus on consistent, long-term investments. This approach minimizes risk, reduces anxiety, and sets you on a path toward financial success. Number 3. Overpaying. During market bubbles and speculative manias, investors often get caught up in the hype and overpay for assets. This can significantly impact your returns and expose you to unnecessary risk. Warren Buffett emphasizes the importance of valuation, stressing that even the most wonderful businesses can be poor investments if you pay too high a price. No matter how wonderful a business it is, there always is a risk that you will pay a price, and that it will take a few years for the business to catch up with the stock. Buffett once said at a shareholder meeting, "This means that if you buy a stock at a high price, it could take years for the company's performance to justify the investment." Let's break this down with an example. Imagine a stock trading at 100 times its earnings per share, PE ratio. If the price and earnings remain constant, it would take 100 years to recover your initial investment. That's a long time, and it's based on the assumption that the company's earnings will remain stable, which is often unpredictable. Now, compare this to a stock trading at a PE ratio of 5. In this case, it would take only 5 years to recover your initial investment, assuming no growth in earnings or stock price. This lower valuation means you're taking on less risk because your investment is more closely tied to the company's actual earnings rather than speculative future growth. Buffett prefers investments that are low risk and offer a reasonable chance of a solid return. For instance, Bank of America, Buffett's second largest holding, trades at a forward PE ratio of roughly 13 as of July 2024. This indicates a more reasonable valuation compared to a high-flying tech stock like Tesla, which trades at a forward PE ratio of 99. The difference in these ratios highlights the varying levels of risk and potential reward. Investing at a sensible valuation ensures that your returns are more predictable and less dependent on market sentiment. It also means that even if the stock doesn't grow as expected, you're still likely to see a return on your investment through the company's organic earnings. Warren Buffett's investment wisdom boils down to avoiding common mistakes. By understanding the difference between investing and speculating, resisting the temptation to time the market, and being mindful of valuations, you can set yourself on a path to financial success. Remember, as Buffett says, You only have to do a very few things right in your life, so long as you don't do too many things wrong. If you found this video helpful, please like, share, and subscribe to our channel No Money for more amazing content. Thank you for watching, and remember, the key to smart investing is avoiding costly mistakes.